The air in the courtroom is stale, thick with the scent of paper and quiet desperation. A lawyer for Lehman Brothers stands. His voice is flat, devoid of emotion as he reads from a filing. Chapter 11. Assets, $639 billion. Debts, $619 billion. The date is September 15, 2008. The largest bankruptcy in American history has just begun. Outside, a global financial system built on confidence is seizing up, paralyzed by fear. How did the dream of American homeownership, a bedrock of middle-class stability, become the engine of the greatest financial catastrophe in a generation? This wasn't just a failure of a single bank. It was the failure of a system that was designed, piece by piece, over decades, to do exactly what it did. This is the story of how the US housing market was built to create winners and losers, and what happens when the losers can no longer pay. To understand the crash of 2008, we must travel back to another crisis, the Great Depression. In the early 1930s, the American dream of home ownership was a nightmare. Banks failed by the thousands, taking family savings with them. Mortgages were short-term loans, typically 5 to 10 years, and homeowners had to pay a huge balloon payment at the end. When the economy collapsed, banks refused to refinance, and millions faced foreclosure. The government needed a solution, a way to stabilize the market and restore faith. In 1934, President Roosevelt's New Deal created the Federal Housing Administration, the FHA. Its promise was revolutionary. The FHA wouldn't build houses or lend money directly. Instead, it would insure mortgages made by private lenders, guaranteeing them against default. This simple act of insurance transformed everything. It allowed for the creation of a new kind of financial instrument, the 30-year, self-amortizing, fixed-rate mortgage. Before the FHA, a mortgage was a short-term, high-risk gamble for both lender and borrower, like a series of short, rickety bridges over a canyon. The 30-year mortgage was a single, steel suspension bridge, designed to last a generation. For the first time, home ownership became predictable, affordable, and accessible for millions of Americans, fueling the post-war suburban boom and building the modern middle class. The system worked. But this simple system of a local bank making a loan to a local family wouldn't last. The demand for housing and mortgages grew, and Wall Street saw an opportunity. The system needed more capital, more fuel. This led to the next major innovation, pioneered by government-sponsored enterprises like Fannie Mae and Freddie Mac. It was called the mortgage-backed security, or MBS. This is the hidden plumbing of the housing market, and here's how it worked. A bank in Ohio makes a loan. It then sells that loan to Fannie Mae. Fannie Mae bundles it with 1,000 other loans from across the country into a single package, a mortgage-backed security. It then sells slices of this package to a pension fund in California or an insurance company in Germany. The bank in Ohio gets its money back instantly, ready to make another loan. The investor in Germany gets a steady stream of income. The risk has been spread, but it has also been obscured. Suddenly, a hidden flaw appeared in the architecture. The originator of the loan, the bank in Ohio, no longer owned the risk of that loan going bad. Their incentive was no longer to ensure the borrower could repay over 30 years. Their incentive was simply to generate more and more loans to sell into the machine, collecting a fee for each one. The bridge was still there, but the inspector had been sent home. This flaw became a catastrophic failure in the early 2000s. The financial machine was hungry. It demanded more mortgages to create more mortgage-backed securities. To feed it, Wall Street turned to subprime mortgages, loans made to borrowers with poor credit, little income, and no down payment. At the same time, a new, even more complex financial product was invented, the collateralized debt obligation, or CDO. A CDO was like a financial sausage. It took the leftover, less desirable parts of mortgage bonds, the riskiest, subprime slices, ground them up with other assets, and packaged them into a new product that rating agencies stamped as safe, top-tier investments. The problem is, no one knew exactly what was inside. Then, the catalyst. The Federal Reserve began raising interest rates. Millions of subprime borrowers with adjustable-rate mortgages saw their monthly payment skyrocket. They couldn't pay. They couldn't refinance. Foreclosures began to spike. The chain reaction was immediate. The value of CDO tranches fell by 90% on a trader screen. 1,000 miles away, a for sale sign went up on a suburban lawn. The mortgage-backed securities and CDOs became toxic waste on bank balance sheets. No one knew what they were worth, so no one trusted anyone else. Credit markets froze. And institutions like Lehman Brothers, heavily invested in this toxic alphabet soup of finance, simply collapsed. So, has anything changed? The core mechanism persists. Private equity firms are now major players, buying up thousands of single-family homes and bundling the rental income into securities. The machine still separates the originator of a loan from the ultimate owner of the risk. The 2008 crisis wasn't a black swan event. It was the logical conclusion of a system that incentivized the creation of debt without accountability. The key variable to watch is always the same: who owns the risk? So, the collapse of Lehman Brothers wasn't an isolated event. It was the moment the intricate, invisible architecture of the housing market buckled under the weight of its own design. The flaw wasn't in one bank, it was in the blueprints. Understanding the journey from the FHA to the CDO isn't just financial history. It's a lesson in how systems evolve, how incentives shape behavior, and how risk can be hidden but never destroyed. It's the key to understanding the financial world we live in now. The American housing market was built to create the dream of ownership. But in perfecting the machine to finance that dream, it also perfected a way to concentrate wealth and distribute risk. The winners and losers weren't an accident of the crisis. They were a feature of the design. Thanks for watching.